Hello, children. How are you? Hope all of us are doing good. Now, today we will begin with our eighth chapter, and the topic is Banks and the Magic of Finance. Now, children, the learning objectives in this chapter are Introduction, what are banks and what do they do, other financial institutions, payment modes and systems, and stock market. Now, children, before we begin this chapter, let us ask ourselves a few questions to ponder. How do digital payments make financial transactions faster and safer? Why is the RBI important for maintaining stability in the banking system? And how do banks help the economy grow through deposits and loans? So let's begin with the introduction. Now, in the earlier chapter, we read about India's physical infrastructure in the form of roads, railways, ports, and telephone networks. Now, they help people to travel, communicate, and carry out economic activities. But for most of these activities to happen or take place smoothly, what is required? Money is required. And this is possible because of financial infrastructure. So, financial infrastructure is a system made up of banks, payment services, stock markets, insurance companies, and other financial institutions. Now, they help people to save money, to borrow money when they require, to make payments, to invest, and also to manage financial risks. Now, the financial infrastructure also helps the government to collect money and spend that money on building schools, hospitals, roads, and other public facilities. So, in simple words, financial infrastructure helps money flow smoothly in the country, just like physical infrastructure helps people and goods to move from one place to another. So, let us understand this through the story of borrowing and saving money in the bank. So we look at this person, Navdeep, who works as a delivery manager in a courier company. Now, every month he saves rupees 3,000 from his salary, but keeping that money in his cupboard may not be safe. So he decides to deposit his savings in a bank. He visits the bank and opens a savings account. By keeping his money in the bank, it remains safe and also earns interest. Now we look at this lady, Rima, who runs a small tailoring business. Now she stitches clothes for people in her neighborhood. Now to buy a new sewing machine and more cloth, she needs extra money to grow her business. So she decides to take a loan from the bank and repay it later. The bank gives her the required amount. Thus, Navdeep deposits his surplus money in the bank, and the bank uses this money to give a loan to Rima for her business. In this way, the bank helps both savers and borrowers. So, what are banks and what do they do? So we see banks around us and they are very important in our daily lives because they help the people to carry out money related activities in an easy and safe manner. So some of the main services provided by banks include saving money, withdrawing money, borrowing money, that is taking loans. So many people like farmers, shopkeepers, teachers, nurses, workers, businesses and institutions, they avail these services that are given by the banks. So in order to use these services of a bank, first of all, a person has to open a bank account. Once the account is opened, then that person or business is called a bank account holder. And then afterwards, the bank provides many useful services to that account holder. So a bank accepts and safely keeps people's money. So the money that people keep in a bank is called a deposit, which means the money that is placed in a bank account of that person. So that person or business can then withdraw that amount of money or whatever amount is required. And till the time the money remains in the bank, it also earns interest. So in this manner, the bank is doing two main things with the deposits that are being made by the people. They keep our money safe, they help our money grow by giving us interest. Then banks also use this money that has been deposited to give loans to other people or businesses. So let us look at the types of bank accounts. So there are different types of bank accounts based on the different needs with regard to saving and using money. To meet these needs, banks provide different types of bank accounts. So there are three main types of bank accounts: savings account, current account, and fixed deposit account. Savings account. Now, this account is meant for those individuals who save their money on a regular basis. So, the money which is deposited in this account, this earns interest for that person. So, a savings account can be opened with a small minimum deposit also, and money can be deposited or withdrawn as is required by that person. However, there is usually a limit on the number of withdrawals that can be made in a month. This account encourages the habit of saving among people. Next is current account. Now, this is generally used by business persons, shopkeepers, and traders who have to either make payments or receive payments frequently. So, this account does not earn interest. However, there is usually no restriction on the number of times that money can be deposited or withdrawn from this account. It is mainly used for day-to-day business transactions. Then third is the fixed deposit account. Now it can be opened by depositing a lump sum amount for a fixed period of time, which can be 3 years or 5 years. So this money cannot be withdrawn before the completion of that fixed period of time. In case it is withdrawn before the completion of that fixed period of time, then the person has to pay a penalty. After the fixed period is over, the bank then returns the original amount along with interest. The rate of interest on fixed deposits is usually higher than that on a savings account. This type of account is suitable for people who wish to save their money for a longer period. So when people keep their money in a bank, the bank pays those people some extra money which is called its interest. Now this interest is given at regular time intervals. It can be monthly, quarterly or yearly. So in this manner, the banks encourage people to save their money. So let us understand this with a simple example. Let us now understand how savings can increase significantly when money is kept in a bank for a long period of time. Suppose somebody has received 1,000 rupees as a birthday gift. Now, instead of spending that money immediately, the person decides to deposit those 1,000 rupees in his or her bank account. Now, the bank offers an interest rate of 6% per year on that person's savings, provided that person does not withdraw the money during this time period of 1 year. So, when the first year ends, the total amount in that account will be the original amount, that is the 1,000 rupees plus the interest that has been earned for that 1 year. So this can be calculated in this following manner: original amount plus 1 year's interest, meaning rupees 1,000 plus 6% of rupees 1,000, which means rupees 1,000 plus rupees 60, which makes the amount to be rupees 1,060. So if this person does not withdraw that money even in the second year, then again interest will be earned on not just the original amount of rupees 1,000 but also on the extra rupees 60, that was the interest that had been earned during that first year. So this means that now this person will get an interest on rupees 1,060 in the second year. So the second year also the interest will be 6%, which is 6% of 1060, which is equal to rupees 63.60. So now after the second year, the bank account will have the money that is rupees 1060 plus rupees 63.60, which makes it rupees 1123.60. So this way we see that the interest that has been earned is not only on the original amount that had been deposited in the first year, but also on the interest that had been earned in that 1 year. So the interest earned keeps on increasing after every year. So in the first year, the interest was rupees 60. In the second year, it increased to 63.60. In the same way, it will continue to increase in the third year and the years to follow. Now, this process of earning interest on both the original amount and the previously earned interest is known as compounding, and it helps the money to grow faster over time as each year's interest is added to the total amount. So, if this person continues to save this amount in the bank for, let us say, 12 years at the same rate of interest, then after 12 years, that person's money will grow to 2012.20. So this shows that compounding is a powerful financial concept that helps the person's savings to grow steadily and significantly over a long period of time. So this picture shows money grows due to compounding. The magic of compounding, the story of a king and a stage. So a king from Ambalapuzha in Kerala was well known for his great love for chess. Once a visiting sage challenged him to a game of chess. The king proudly declared that he would give the sage any reward of his choice if the sage managed to defeat him in the game. The sage asked for what appeared to be a very simple reward. He requested that 1 grain of rice be placed on the first square of the chessboard, 2 grains on the second square, 4 grains on the third square, and the number of grains should continue to double on each of the 64 squares of the board. The king was surprised at such a small demand and immediately agreed, thinking that the reward was too tiny to be of any importance. However, the king lost the game. He then ordered his courtiers to place the rice grains on the chessboard exactly as promised, as we can see in this picture here. So on the first square, 1 grain was placed. On the second square, 2 grains were placed. On the third square, 4 grains were placed. By the eighth square, which was the last square of the first row of the chessboard, the number of grains had already increased to 128. The ninth square had 256 grains. The 10th had 512 grains. The 11th had 1024 grains, and the numbers continued to double in the same manner. As the counting went on, the total number of grains increased very rapidly. By the 16th square, the number of grains had reached 32,768. By the 32nd square, the total had crossed more than 210 crore grains. At this point, the king realized that the number had grown beyond his imagination. The king now understood how powerful exponential growth can be, but only after it was too late. This story clearly shows how compounding works and how even a very small amount can grow into a very large quantity when it keeps doubling over time. Now let us look at importance of keeping records of financial transactions. So we might have seen a passbook. Now a passbook shows what all money has come into the account. That is the money that has been credited into the account and all the money that has been taken out of the account, meaning the money that has been debited from that account. So when we look at the passbook, we can see entries like the salary received, rent paid, shopping expenses, interests earned, and other charges. So this shows how money is being used and managed. So this is a picture that shows the entries in a passbook. So keeping records of financial transactions is important for the following reasons. It helps us to know how much money we have in our bank account at any time. It helps us to track our income and expenses and understand where our money is being spent. It helps us to plan our savings better by controlling unnecessary expenses. It acts as a proof of payment or receipt in case of any mistake or dispute. It helps the bank and the account holder to avoid errors and fraud. It is useful while applying for loans, scholarships, or income verification. So, when proper records of financial transactions are kept, then people can manage their money wisely, they can save regularly, and also stay financially disciplined. Offering loans or credit. Now, we know that banks, they keep people's money safe, but they also lend money to those who need it. So this money is given in the form of a loan. So what is a loan? It is an amount of money that is borrowed from the bank for a specific purpose, and it must be paid back over time. So people might take loans for many reasons, like to buy a house, purchase a vehicle, pay for education, or meet emergency expenses. Then businesses also take loans, as we had seen in a previous example. So they may borrow money to buy new machines, purchase raw materials, transport goods, or introduce new products in the market. So the banks, we know that they pay interest to people who deposit their money. But then they also charge the interest from those who have borrowed money from them. So this interest is the extra amount that borrowers must pay in addition to the amount that they have borrowed from the bank. The borrower repays the loan and the interest in small amounts over a fixed period of time, such as every month. So, when the entire amount is paid back, then it is said that the loan has been cleared. Now, loans are useful because they help people and businesses to meet their needs even when they do not have enough money at that particular time. So in this manner, the banks support economic activities and also help in the growth of the community. Now, children, be aware of banks give lower interest on savings deposits to the people who keep their money in the bank and charge higher interest rates from those who borrow money. The difference between these two interest rates becomes the bank's income. Let us understand this with an example. Shri Anand deposits rupees 200 in his bank account. The bank gives him interest at the rate of 2%. The bank then lends the same rupees 200 to Kumari Shreya and charges her interest at the rate of 5%. So Kumari Shreya repays the loan by paying back the original amount of rupees 200 plus rupees 10 as interest, which is 5% of rupees 200, making a total of rupees 210. From this, the bank pays rupees 4, which is 2% of rupees 200 to Shri Anand as interest on his deposit. The remaining rupees 6 becomes the bank's earning. It is important to note that the banks keep some amount of money as reserve and do not lend all deposits to individuals or business. So this picture here or diagram here, it illustrates how banks make money with what we had read earlier. How the Jan Dhan Yojana changed banking in India. So before 2014, only around 15 crore people in India had bank accounts. Now, many people, especially those with low incomes, depended mainly on cash for their daily needs. To address this, the government of India launched the Pradhan Mantri Jan Dhan Yojana in 2014. The aim of this scheme was to provide every Indian with access to a bank account even if they could not maintain a minimum balance or pay bank fees. Since the launch of the scheme, more than 50 crore bank accounts have been opened, and a large number of these accounts belong to women. Today, people from all sections of society are able to use banking services. For example, farmers can borrow money from banks to start or expand their agricultural work. Workers receive their wages directly in their bank accounts. Students who perform well in their studies get scholarships credited directly into their accounts. These direct transfers reduce the role of middlemen and help ensure that money reaches the right people quickly and safely. Other financial institutions. So, we have read about banks as financial institutions which are used by people to save money and also to borrow money. Now, there are many other such institutions that provide financial services to the people in India. One of the most important among them is the Indian Post Office. So, here is a picture of a post office. Now, they offer many useful savings schemes such as the National Savings Certificate NSC, Kisan Vikas Patra account, and the Sukanya Samriddhi account. Now, because post offices they have branches even in very remote village areas, so they become a popular choice for saving money, and especially for those people who are living in the rural areas. So there are other financial institutions also that support specific sectors of economy. For example, the Industrial Finance Corporation of India, IFCI, provides financial support to industries such as power, textiles, and manufacturing. Now, this helps the businesses to grow and to create more jobs. Then another important institution is the National Bank for Agriculture and Rural Development, NABARD. So, as the name suggests, NABARD, it works to support rural development by providing funds to banks so that they can give loans for farming, small village industries, dairy farming, and important rural infrastructure like roads, irrigation facilities, and storage houses. So there are so many banks and financial institutions which are working across the country. So it is important that there are some clear rules and regulations which make sure that the financial institutions are functioning safely and fairly, and to protect people's money and also to maintain trust in the financial system. So this leads to the question, who sets and monitors these regulations? Now, the Reserve Bank of India, that is RBI, is the organization that sets rules for banks and monitors their activities in India, and it is known as the Central Bank of India. Now, every nation has its own central bank which supervises its banking system and also manages the policies which make sure that the banks are functioning safely and efficiently. The Reserve Bank of India was established in 1935. So, when India gained independence, it was taken over by the government of India in 1949. And from that time onwards, it has been functioning as the banker to banks and the central authority that oversees the entire banking system. Now, the RBI performs several important functions. It frames guidelines and rules that all banks must follow. It ensures that banks keep enough money in reserve so customers can withdraw their savings whenever needed. It supervises and checks whether banks are working honestly, safely, and efficiently. It maintains accounts of other banks and helps them exchange funds with one another. It provides loans to banks as well as to the government when needed. It controls the supply of money in the country and works to keep inflation under control. Now, the RBI regulates and guides different banks, and it also helps to maintain stability and trust in the financial system. So this ensures that people's money remains safe and that the economy works smoothly. So this is a picture of the entrance of RBI office in Delhi. Now, RBI sets several important rules and regulations that guide how banks in India work. Some of its major responsibilities include printing and distributing Indian currency such as banknotes, fixing the benchmark interest rates for the country. Now, the benchmark interest rate is the base interest rate that the RBI decides for lending money to commercial banks. These banks then use this rate to decide the interest they will charge on loans and the interest they will give on deposits. An interesting feature of the RBI office in New Delhi is its entrance, which is guarded by statues of a yaksha and a yakshi, as we saw in the picture above. In Hindu mythology, yakshas are considered demigods who protect the treasures of Kuber, the god of wealth. In a similar way, the Reserve Bank of India protects and manages the country's money. Because it alone has the authority to issue currency and because it acts as a banker to all banks, the RBI can be compared to Kuber, the guardian of wealth. In ancient India, temples often acted like banks. They did not take public deposits, but they lent money to artisans, traders, and local rulers for various activities. The agreements for these loans were written on copper plates, many of which still survive today. This is a picture of copper plates with inscriptions from Pandya kingdom. One such copper plate from 13th century Kodumbalur in Tamil Nadu records that local communities borrowed money from the Tirumudu Kunra Mudaya Nayanar temple and agreed to pay interest. This shows that organized lending existed in India long before modern banks. Payment modes and systems. Now, the payment modes and systems, they form an important part of a country's financial infrastructure. So it is because of them that it becomes possible for money to move safely and quickly from one person to another. Now, traditionally, people used cash, checks, and debit cards for making payments. But nowadays, we see that digital payment systems like the Unified Payment Interface or UPI, they have become extremely popular and they allow instant and convenient money transfers. So before looking at the modern payment systems, let us understand how account holders can withdraw money from their bank accounts. So there are two common ways to withdraw savings. First is withdrawal slip at the bank. Now this is a picture of the withdrawal slip. Now the person can visit the bank, fill out a withdrawal slip, submit it at the cash counter and then collect the required amount of cash. Now this slip includes details such as the account number, amount to be withdrawn and the account holder's signature. So as we see in this picture, here you have to fill the name of the bank branch, here the amount of money in number, here the person has to write his or her account number. Now here this line is to be filled by the bank. Then here the date has to be mentioned, here the amount of money in number, then here the rupees in words, then in this line signature of the account holder comes and here comes the name of the account holder. Debit card and ATM. So when a customer opens an account in the bank gives that customer debit cards. Now these cards allow people to withdraw cash anytime from an automated teller machine or ATM. Now these are the self-service machines that are found in public places like bus stations, markets, railway stations, airports and malls, and they work like mini banks that are available 24/7. Now, in order to withdraw cash, the person has to first insert his or her debit card into the ATM, then enter a PIN, which is the personal identification number, and then type the amount that the person wishes to withdraw. The machine then gives out or dispenses that amount of cash. A payment system is a mechanism that enables the clearing and settlement of financial transactions. It helps individuals, businesses, and organizations transfer funds securely and efficiently. Now, what is a PIN? A PIN is a 4 to 6 digit numeric code which is used to verify a user's identity, and it also ensures safety during financial transactions. Now, when we look at the growth of digital payments, these systems have made transactions not only faster but also safer and more convenient for people across the country. So, this is a picture showing an ATM, and this is a picture showing a debit card, the front and the back side of that card. So, how can money be transferred from one bank account to another? Now, money can be sent from one person to another using a lot of different methods. Now, there are some traditional methods which are slower, and there are some methods which are modern, which are quicker because they allow instant transfer of money. So, let us learn about these methods in detail. Check. Now, check is a paper instrument which is issued by a bank, and it allows a person to pay someone directly from his or her own bank account. So every account holder receives a checkbook which contains several blank or empty checks. For example, if you want to pay rupees 5,000 to your friend Rohan, you write the amount rupees 5,000, Rohan's name, the date, and your signature. Rohan can deposit this check in his bank branch or drop it in the check box. After checking the details, the bank withdraws, that is, debits the amount from your account and adds or credits it to Rohan's account. So, this is a picture of a check. So, here is the name of the person you wish to pay, that is to be written. Here you have to write the date on which you wish to issue the check. Here you have to write the amount of money in words. Then here you write the amount of money in numbers. Here you write the check issuer's account number. Then here, now this is the space where the check issuer needs to sign. And here we see the check number, and this is the MICR code, and this is the MICR band. Now, when we look at the payments that are made through checks, they take a lot of time because the check has to be, first of all, physically taken to the bank. Then the bank has to verify the signature, and the transfer is completed only after processing. So, people nowadays therefore prefer electronic modes of payment which allow for instant transfers from one sender's account to the receiver's account. And these modes of money transfers are called electronic payment modes. Electronic payment methods. Now, electronic transfers allow money to move from the sender's account to the receiver's account within seconds. So, unlike the checks, the electronic payment methods do not require a physical visit to the bank. So let us explore the main types. Debit cards and point of sale, that is POS machines. This is a picture of debit card being used in a POS machine. So a debit card is linked to your bank account. It helps you use your own money in two important ways. First is withdrawing cash from ATMs. Debit cards can be used at automated teller machines or ATMs to withdraw cash. The steps are: insert the debit card into the machine, enter your PIN, that is personal identification number, type the amount you want, collect your cash. ATMs work like small self-service banks available anytime, day or night. Next is making payments at shops. So shops such as grocery stores, clothing stores, chemists and restaurants use point of sale, that is POS machines, as we saw in this picture here. To make a payment, the cashier enters the amount in the POS machine. You swipe or insert your debit card, you enter your PIN. The amount is instantly deducted from your account and transferred to the shopkeeper's account. This method is fast, safe, and reduces the need to carry cash. Next is internet banking or net banking. Now, this allows the bank customers to use services through a computer or even a smartphone. Now, with net banking, a person can check their balance anytime, view past deposits and withdrawals, transfer money to another person's account, pay bills and fees, and buy tickets or recharge mobile phones. Since it works through the bank's website or app, it saves time and makes banking possible even from home. So this is a picture showing internet banking using a computer. Third is mobile payments. Now this is another popular method where payment can be made using a mobile phone through some apps. So apps like BHIM allow digital payments using the Unified Payments Interface or UPI system. UPI is a fast, simple and secure payment system that works with QR codes, mobile numbers or UPI IDs. Now this is a picture of QR code used for payment. Now UPI allows money to be sent instantly even if the sender and receiver have accounts in different banks. It reduces the need to update passbooks because every payment appears immediately on the phone. The app shows past transactions and the current balance, and everything is stored safely in digital form. So if you look at this diagram here, it shows the process of a digital transaction between a buyer and a seller using UPI. So this here we see Kumar scans Piyush, who is a vegetable vendor, his QR code using a payment application on his phone, enters his UPI PIN and the amount to be sent. Now here we see the process of a UPI transaction. This is the payer's bank. Then the bank forwards the request to NPCI. The NPCI decrypts the request, verifies the user's UPI PIN and processes the transfer. Then the funds are received by the payee's bank, that is Piyush, and the payee, that is Piyush, receives the payment in his bank. Unified Payments Interface, that is UPI, India's gift to the world of payment systems. So transfer of money before UPI was very slow and was often also inconvenient, as people had to write details on a check, then drop the check into a bank's drop box, and then they had to wait for 2-3 days for the amount to be credited. So because of this, there were people who avoided bank transfers and they depended on cash transactions, which meant that billions of rupees moved daily without any proper records. So in 2016, the National Payments Corporation of India, NPCI, it launched UPI, which transformed the way people transferred money. So UPI is fast, money transfers in seconds, secure, available 24/7, free of cost, and supports multiple Indian languages. Now let us look at the example of UPI transfer as we saw in the picture earlier. Let us read this now. Suppose Kumar buys a notebook from Piyush. Kumar opens a UPI app on his mobile. He scans Piyush's QR code and enters his phone number. He types the amount, he enters his UPI PIN. Within seconds, the money is sent to Piyush and both receive a confirmation message. UPI enables contactless payments, which was very important during the COVID-19 pandemic, and even small amounts like rupees 10 can be transferred very easily. And it does not require a checkbook, ATM, or even a bank visit. So it has made digital payments accessible to students, shopkeepers, farmers, workers, and even street vendors. Thanks to UPI, India has one of the world's most advanced digital payment systems. Now let us look at stock markets. So we already know there are different types of markets like the retail markets, wholesale markets, and even online markets. But then there is another kind of market which is called the stock market, and it is much bigger and more complex. So you can imagine it like a huge online marketplace, but here one does not buy things or clothes or books, etc. Here people buy and sell shares of companies. So what are shares? Now imagine a situation where somebody is running a small restaurant and that person wants to expand his business by offering more cuisines, but that person requires extra money for that expansion. And since that person does not have so much of savings, that person can ask friends to contribute some money. Now, in return, the friends who give some money, they get a small portion of his restaurant's profits. So this means that those people who have given the money now own a part of that person's business. So this is exactly how shares work. So a share is a unit of ownership in a company. So when a person buys a share, that person becomes a part owner of that company. So the more shares this person buys, the bigger this person's ownership in that company becomes. So we can compare it to a big chapati. If we cut different or smaller pieces of that chapati, then each piece of that chapati is a share, and a collection of these pieces is called stock. So this picture here, this picture, it shows a share certificate in earlier days. Now, people buy stocks in order to grow their savings. So, if the value of a share increases over time, the person who owns that share may earn a profit. On the other hand, companies issue shares to raise money for their work, such as building factories, employing workers, or launching new products. Now, where does this buying and selling of shares take place? It happens in a place which is called a stock exchange. So, India's most well known stock exchange is the Bombay Stock Exchange, or BSE, which was established in 1875. This is a picture of the Bombay Stock Exchange. Now, it is one of the oldest stock exchanges in the world. So, in early days, buying and selling of shares was done manually using paper slips, as we saw in the previous picture. Nowadays, the stock markets have been transformed because of advancement in technology. So, all transactions are now made digitally through computers, the internet, and advanced trading systems, and this allows people to buy and sell shares within seconds. So here this picture shows a rise in the prices of shares of a large number of companies causing a stock market boom, and this picture shows a fall in the prices of shares of a large number of companies causing a stock market crash. Rise in share prices. So we have seen that in case of commodities like vegetables or groceries, their prices change every day. Similarly, the price of the shares also change. They may rise or they may fall. If many companies shares prices drop at the same time, it causes a stock market crash. And if many share prices rise together, it leads to a stock market boom, as we saw in those pictures. So these changes can bring profits or losses to the people who have invested money in buying those shares. So we see that the prices of the shares, they usually increase if a company is performing well, if it is earning a good profit, if it produces popular products, or people believe that the company will grow in the future. When more people want to buy a company's shares, the prices go up. Fall in share prices. So The prices of the share, they can fall when a company suffers a loss, it faces a problem like poor quality products, its workers go on strike, or management issues arise. So then there are fewer people who want to buy those shares and the prices then drop. Now, other reasons for price changes. Now, share prices can also be affected by new government laws, changes in taxes, elections or political instability, wars or conflicts in other countries, natural disasters, or economic shocks such as inflation. So, this is why investing in shares can sometimes be risky. Financial frauds and how to prevent them. Now, we have seen that with the introduction of digital modes of payment, sending or receiving of money has become easy. But then it also requires for people to become very careful. Some people, known as fraudsters, try to cheat others and steal their money through clever tricks. These fraudsters may make fake phone calls, send false messages, and pretend to be bank employees or ask people to download unsafe apps. Their aim is to convince people to share important information such as bank account numbers, ATM pins, debit card details, or one time passwords or OTPs. If someone shares these details by mistake, the fraudsters can gain access to their phone or computer and steal money from their bank accounts. To stay safe from digital fraud, one should never share an OTP PIN or bank password with anyone. It is important not to click on unknown links or download apps sent by strangers. Banks never ask for OTPs or passwords on phone calls or messages, so one must be cautious before responding to any message claiming to be from a bank or company. Now, children, beware. Never share personal information such as your phone number, bank account number, home address, passwords, or OTPs with strangers. Avoid clicking on unknown links, videos, or attachments sent through messages or emails as they may be harmful. Do not store sensitive banking details like account passwords, debit card pins, or other confidential information on your mobile phone or computer. If a person becomes a victim of online fraud, it should be reported immediately by calling the emergency helpline 1930 or by filing a complaint on the National Cybercrime Reporting Portal. Being alert and well informed helps protect our money while using digital payment methods. So, children, let us look at the trail treasures. Bank is a financial institution that collects money from people in the form of deposits and gives money to people or borrowers as loans. Deposits means money placed in a bank account that can be withdrawn according to the bank's rules and usually earns interest. Quarterly means something that happens 4 times in a year, once every 3 months. Interest is the extra amount charged for borrowing money or the extra amount earned when lending or saving money, usually shown as a percentage. Debit is the process of taking money out of a bank account. Credit is the process of adding or receiving money into a bank account. Loan is an amount of money borrowed from banks or financial institutions that must be repaid later along with interest. Benchmark interest rate is the base or standard interest rate fixed by the RBI for lending money to commercial banks. Payment system is a mechanism that helps in clearing and settling financial transactions, allowing people, businesses, and organizations to transfer money to one another. PIN is a secret numeric code, usually between 4 to 6 digits, used for identity verification and security, especially during financial transactions through ATMs or debit cards. Share. A share is a unit of ownership in a company representing a small portion of its capital stock, which entitles the owner to part of the company's profits. Investment is the act of putting money or resources into assets with the expectation that their value will increase over time. Stock exchange is a marketplace where financial securities such as stocks and shares are bought and sold. Economic shocks means sudden and unexpected events that cause major changes in a country's economy, affecting how people earn, spend, and save money. These may be caused by natural disasters, wars, pandemics, changes in government policies, or sudden changes in the prices of important goods. Tax rules are regulations set by the government regarding the taxes that individuals and businesses must pay on their income, profits, goods, services, and transactions. OTP is a unique temporary code made of letters or numbers used for verifying identity or authorizing a transaction. Now, children, let us dig into learning. Financial infrastructure includes banks, payment systems, stock markets, insurance companies, and post offices, helping money flow smoothly in the economy. Banks allow people to save, withdraw, and borrow money by opening a bank account. Deposits are kept safely in banks and earn interest. Banks use these deposits to give loans. Different accounts serve different needs: savings accounts, current accounts, and fixed deposits. Interest helps savings grow. Compounding makes money increase faster over time. Keeping financial records like passbooks helps track income, expenses, and account balance and acts as proof in case of disputes. Banks give loans to individuals and businesses for various needs and charge interest on these loans. Schemes like the Jan Dhan Yojana help millions open bank accounts, enabling direct benefit transfers. Post offices offer savings schemes like NSC, Kisan Vikas Patra, and Sukanya Samriddhi and are widely accessible in rural areas. Institutions like IFCI and NABARD support industry, agriculture, and rural development through loans and funding. The Reserve Bank of India, RBI, regulates banks, ensures financial stability, prints currency, and sets benchmark interest rates. Payment modes include withdrawal slips, ATMs, debit cards, internet banking, mobile banking, and digital systems like UPI. Checks allow payments from one account to another but are slower than electronic transfers. Debit cards allow ATM withdrawals and payments at shops using POS machines. Internet and mobile banking enable faster, convenient, and paperless transactions. UPI allows instant, secure, and 24 by 7 money transfers using QR codes, phone numbers, or UPI IDs. The stock market is where shares of companies are bought and sold. Buying a share means owning part of a company. Share prices rise and fall based on company performance, economic conditions, government policies, and global events. Digital fraud happens through fake calls, messages, and requests for personal information like OTPs or PINs. People should never share sensitive banking details and must report fraud immediately to helpline 1930 or the cyber crime portal. So children, I hope that this chapter is clear to all.